Hello and good morning, everyone. Welcome back to Almus Market Mornings, your daily dose of global financial updates. US retail sales beat expectations and push yields higher, but surprisingly, dollar remains indifferent. We have been speaking of yields on the longer end go higher, but this time we also had the shorter tenor yields push higher, with 2-year yields hitting a new cycle high. Good morning, JK. Interesting set of moves yesterday. Keen to hear your take on the yields movement.
Good morning, Swaraj. Actually, the focus of the markets have been, drawn back into the economy in the last couple of days. And yesterday was big day for US because the macro data all showed much improvement. In fact, US retail sales increased more than expected. Households stepped up purchases of motor cars and online spending, and all these actually cement an expectation that the economic growth will be higher in the third quarter. We already had a second estimate which showed 2.1% in growth in US GDP, which is much higher than Europe and UK or even Japan. So this adds to the expectation of a higher growth. So retail sales were also higher on year basis. But there are concerns of going forward because the interest rates remain high. The consumption can eventually get affected. We also see student loan repayments affecting the liquidity left with the consumer. So all this could be a challenge going forward. But right now, the sales number have been very encouraging. Industrial production for September also rose 0.3% versus 0.1% expected, although August number was slightly revised down. Manufacturing production was higher as well. And, this is adding to the sense that, manufacturers are coping up with the higher interest rates, and the higher production is also due to the higher demand that they are seeing. Once again, as interest rates and yields remain higher, it remains a challenge whether the current level of output can be maintained as far as the businesses are concerned. We also had the business inventories, which is another indicator of strong expected sales, that rose 0.4% in August compared to just 0.1% in July. So higher business inventories actually add to the GDP number. So overall number from US was much better. Then we also had the macro data from Europe, where the ZEW data from Eurozone as well as on the Germany side were showing fast improvement. In Germany, the sentiment rose significantly from minus 11.4 to plus 1.1, and that's a big improvement. And then Eurozone was also not lagging. It rose from minus 8.9 to 2.3. And, more participants actually expected the short-term interest rates in Eurozone to stabilize and also reinforce the economic outlook. Only, underwhelming data came from UK, where the data showed that wage inflation was easing off, and that gave rise to expectation that UK may once again hold off a rate rise. Now, in the Asian time, we also had the Chinese data, which gave a surprise to the upside. GDP coming at 4.9 versus 4.4 expected. Retail sales at 5.5 versus 4.9 expected. And industrial production also beating expectation at 4.5 versus 4.3% expected. The cumulative effect of various measures taken by the Chinese authorities may be working through the economy, but many challenges remain as far as the Chinese economy is concerned. Just to quote one example, the US government has decided to ban chip export to China, and this puts on hold the expected improvement in relations that was market was looking forward to after the Chinese premier visit to US, and that has not actually fructified. But short-term relief for the Chinese one, which came off from 7.3 to 40 to 7.3070, and also some boost to the market sentiment in the Asian zone as well. Of course, a strong data from Europe and US both boosted the yields yesterday, and the yields were rising across the curve. In fact, what was more telling was the rise in the 2-year yield, which went to 5.2 0.24, and in fact, market expectations of a rate hike in in December has gone above 35, and for January above 40. These are, while below 50%. Is still there is a big leap from the previous expectations, and definitely two-year yield rising is an indication that some we cannot rule out a totally rate hike. Then 10-year yield went up by 13 basis points to 4.83%, and 30-year by 8 basis points to 4.92%. So with more supplies weighing on the bond prices, a rise in 10-year and 30-year yield through 5%. For me, it looks only a matter of time. On the geopolitical side, there was a small setback as the summit that Jordan had called for with the Biden and the Arab leaders has been called off. So that puts some doubt about the immediate easing of tensions. However, Biden's visit is also being looked forward to. As harboring slight easing of tensions after their meeting with the Israelis. Nobody wants an escalation in the war. That is what the world leaders are trying to convey. On the economic side, we have Powell's speech tomorrow. That's one of the reasons why even the stock markets had which had a conflicting influence, better earnings report versus higher yields. And then the market decided to wait till more indications from Powell also, because right now what we are seeing is the Fed members expression is contrasting with what the market is doing, because market continues to take the yields higher, whereas the Fed members saying that no, economy is cooling off, but that is not reflected in the numbers as yet fully. On the currency side, there was little movement again, but euro was much better supported compared to all others because of the ZEW data, which supported the currency as well as the yields. Otherwise, most other currencies were on the sidelines. On the rupee, again, on the whole of October, we have seen a range of not more than 15 paisa, and that's one of the narrowest ranges that we have seen. Obviously, the usual factors of RBI and market demand playing out in, it almost mirrors what's happening in China, that the market is trading at 7.32. The Chinese central bank continues to fix yuan near 7.18, almost 2% lower than where the USD is trading. So it's market expectation or the market view versus the central bank. That is what is playing out both in India and China right now. Let's see if something changes in this regard. But for now, we continue to look for range trading. Thank you.
Thank you, JK. And the major themes was the US data is showing industrial activity was resilient and even rose in September, while also consumer demand remained strong, as displayed by the industrial production data as well as the retail sales data. Even on the European front, we are seeing sentiments improve for the month of September. And when it comes to China, Chinese GDP came in higher than expected along with retail sales data. So it's showing some impact from the various stimulus measures being undertaken by the Chinese government. Now markets will of course pay attention to what Powell has to say tomorrow. So that again can have some impact on the currencies and stocks and everything. With respect to rupee, nothing home to write about. Very narrow ranges. As JK mentioned, the whole of October we have traded in 15 paisa range. So till the time we have fresh triggers, it will continue to do so. That's it from us today. Thanks for listening. Tune in tomorrow for the latest in the financial markets.